A quick review of markets first. Start off at the daily chart and then see what happened on Friday. All right, so in this downtrend, basically over here you had a low of 482 million, then a lot of liquidation, 1,069 million here. After that, selling abated to about 267 million, rallied, pulled back on about 583 million, but was unable to. It made a low, but it didn't have follow through. So you had increasing. If you take a look right here, when a market attempts to go down and comes back up, it's a fake out or a false break or whatever. So all that pressure and no reward in terms of making a low with the lower high. Instead, it dips below and comes right back within the range. So after that, it finally went up here to test the breakdown, this breakdown area, and then pulled back. So what can we take away from this? The first most important thing here is from price volume perspective, is this heavy volume here was quite climactic. And after that, you had a secondary test, and after that, this is an effortful move. This is what you call like a spring on effort, or a spring but with effort, where you have a lot of pressure. Now, one of the key things is when markets leave a range, they need to have a lower high and a lower low below that range. A lower high and a lower low below that range. Similarly, when markets break out, like over here, there's a breakdown, right? It says BD, it's a breakdown. How do you know it has follow through? It has follow through if it's breaking that range and then has a lower high, lower low below that range. If it doesn't have lower high, lower lows below that range, it's still within the range. So it can just reverse and catapult up, which is what this bar did. It attempted to have a lower high, lower low, but it just, as soon as it made that lower low, it just shot right back up. So it's still within range. And then what happens? It comes back and tests. Remember, when markets break down and they have follow through, which is lower high, lower low below the range that it broke, you want to see how much follow through. If there's a good amount of follow through, then the pullback will test. It'll test the ice in the creek, or basically the breakdown. Just want to test the breakdown. If the market, or like over here, makes a low, right? Makes a low, but it's a very weak low that looks like a shortening of the thrust, chances are very high for an upthrust. So the question is, when can you expect an upthrust? You can expect an upthrust after the market has a shortening of the thrust, or a very weak follow through. You can expect like over here, the market had poor follow through, it had no follow through. So this high is in jeopardy. And that's what happens. Basically, rips, tests. Now the position to go back down again. So now we're going to take a look at it from a breadth perspective. Over here, it made a lower low. After that, it made a higher high on 274. It's 274 net higher highs. That is very good because it's the most amount of higher high, the 1, 2, 3, 4, 5, I don't know, like 5, 6, 7. So this was very telling that there's something up, something's up. Yeah, because bigger than 120, all of these numbers. So this is a lot of markets making higher high, pulled back, and this is where you had a diversion, meaning the stock market went down, but you're not getting low lows from the components. So what does that mean? Well, if you're not getting low lows from the components, why is the market going down? When the market is a function of its components. So it diverged there, and then finally, it basically on the higher highs, it started weakening, meaning 274, then 163, lower. When from 274 to 163, it's less. And then from 163 to 161, it's less. And then finally it diverged here because the market made a higher high, but the components didn't. So there's an issue. That's your market versus component markets, like an index, like a SPY or Qs or whatever, versus its components. So this is diverging. After that divergence over here, you had this break over here. This big bar over here had an increase of 49% in volume than the prior bar. So 49% increase in volume with 208 additional lower lows. It went from 876 stocks making lower lows to 1,084 stocks making lower lows, which is an addition of 208. So 49% increase in volume. 208 additional stocks making lower lows, with a total here of 1,084 stocks making lower lows on an increase of volume, on the biggest down volume in 13 down bars from a test of a breakdown. And it goes to resistance, test of the breakdown, and does that. So that's, what else do you want, right? And then after that, if you take a look at the close when it tried to rally, how much pressure is there? Well, the reversal was on a volume increase of 19% with a higher high, about 810, with an addition of 43. So that's not really, if the addition from one bar to the next is 43 versus here it's 208, that's telling you that the market is not, that's not a strong reversal bar. So, I'll give you an example here. The reversal bar has 230, right? 230. This reversal bar has 278 stocks making lower lows. This one has only 76. This break here has 297. This reversal doesn't have a lot. This reversal has 237 from that spring position. So, 237, 230, here, 208. And what do you have now in this reversal? 43. So that shit ain't going nowhere. All right. It's just not enough pressure. It's probably just end of week covering, but we'll see on, what it sets up. I don't really see any pressure. The volume increase is, it's just around, it is an increase of 19% from the prior day that just tags the moving average, the volume moving average. So I don't really see a lot of danger for bears at this point. Looking at the intraday action, so the market basically went above the prior day high and sold, but the volume is not, it's okay, it's an increase, but it's not really that damaging. The breadth, meaning there was selling pressure, so 831, so that legitimizes it. After that, it made a higher high, and why? Because it was doing a stop run. After that, the market goes down, makes a lower low, but the additional stocks are not breaking. It's almost the same, 831 lower lows, and now you have like 820. So, but what gave it away was after this market, after SPY consolidated, it made another lower low. And you know how much volume? I think it was 19 or 10. I can't really read this, but it's very little. 18 volume, 18 million. So that's relative to 133 million is very poor. So went into a spring position with a low volume spring of 18 million on this lower low. What does breadth tell you? It tells you it ain't going nowhere. Why? It went from 820 to 206, about 1/4. So it's done. There's no selling pressure, and then after that it reverses and breaks out, which sets up the end of day covering to move above the weekly low, prior week low. All right, folks, that's all. Have a good day. Bye.